Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network. So as you can hear, my voice is a little hoarse. My kids were lucky enough, or kind enough really, to get me sick. So no one has COVID, everyone's fine. Now we filmed the EIA and Econ show at the same time. I was able to get through the last two segments of the EIA show without issue. So hopefully I'll be able to do the same for these. But let's hope I'm not coughing in your ear too much. So I apologize in advance. So on the EIA show, on the Econ show, we're gonna do it normal, kind of that five-part breakup. The first part, we're going to look at that global credit pressure and how does that lead to stagflation? Like, where are we on the supply chain, the chip shortfall? Again, all of these issues that continue to kind of come to pass. Then we're going to shift over and look at the regional Fed data, the leading indicators, and realistically, what does that mean for manufacturing? We're seeing some of these slowdowns start to pick up, but prices still remain sticky. Again, stagflation. So that'll be interesting to see kind of how that pivots. And then when we look at the U.S. consumer in the next segment, we want to look at how it has how income is impacted by inflation, like where people's incomes are, where their savings are, but where's price? What is the expectation? Where's real estate? So a lot of these things are going to be very important. And then we're going to look at Europe, where the manufacturing is also slowing in Europe. We've gotten some misses against estimates. We want to go through that, and then what does that mean going forward? And then we're going to talk about China. We're going to talk about our favorite in terms of Evergrande, and then realistically go deeper into why is there a power curbs? What does that mean for production? What does that mean for just activity within China at this point in time as they continue to see some of these pressure points? So now when we turn to and look and kick off with this global credit impulse. So Macro Markets Daily is a great follow on Twitter. If you're not following them yet, I think you should. They put out some really good charts, just a kind of a quick summary. Much better at short form than I am, as I can be very long-winded. But here's where we can start to see some of these credit impulses coming negative. And if you remember, what we've been talking about is as you have a significant amount of fiscal stimulus, you then kind of get this overhang, this slowdown that is then caused on the back end of it as you get some of that demand coming through, and then some of the pressure on growth going as they go forward, with obviously China. Essentially everyone across the board is now showing negative credit impulses, which, as if you look at how that charts against commodity prices, manufacturing, global output, global growth, it's typically on the negative side. So again, a lot of this moderation is something that we still can continue to see as we now end Q3 and go into Q4. That's where we continue to see some of these overhangs on just yearly numbers as well as quarterly numbers in Q3 in terms of where expectations are, and then as we go into Q4. And that's when you start looking at this emerging market cycle where we're seeing this shift over going forward. We've showed this before. We just wanted to show it again because we do think it is a very powerful chart. Just as you're coming into this expanding but decelerating, and now really coming into this contracting and decelerating as we are coming into a rate rising cycle. Now, the U.S. is way more likely to cut QE versus raising rates, but others have already started to do it, trying to get in front of inflation, trying to protect currencies, and we continue to see some of this kind of back and forth as they manage where things are going on an economic footprint. Now, one of the interesting pieces, because we're going to talk about what people expect in the next 6 months, and we're seeing a lot of consumers get very nervous on not only just income, but their job and where the world is going to be 6 months from now. And I think this speaks to that as well, where most think that children will be financially worse off than their parents' generation. And I thought it was an interesting backdrop going around the world, where in the U.S., 68% of respondents think their children will be worse off than their parents' generation, and then 32% said better off. And if you look throughout these countries, many of them think that things will be worse off for in general. And then if you look at the overall, 64% said worse off, 32% said better off. And there's a lot of reasons why. we're coming into a very complicated decade with a mixture of inflation, stagflation, deflation. And as I've said previously, I think we're going to have a very weird amalgamation of the 30s and 70s kind of playing out and battling with each other as rhetoric gets much worse between two large superpowers, China and the U.S. And you're seeing some of this fight back and forth. And at the same time, we're issuing a lot of debt, and that debt has to be paid off. And that's where some of the concern for the future, because essentially you're borrowing from the future, because a lot of that GDP prowess growth is going to have to go to just paying interest and avoiding the need to roll the debt, but actually able to retire it and put some money in the coffers. But in the same time, we have surges around the world in commodities, and cotton is one of them. So supply shortages and growing demand are fueling a rally in cotton prices that are now approaching a decade high. And the surge means clothing prices could get more expensive as manufacturers respond to higher raw material prices, adding to inflationary pressures. Because remember, clothes have been deflationary for a very long time. And that's what we're starting to see, some of these shifts overall, where technology, semiconductors, a lot of these pieces of the supply chain have helped things be cheap and remain cheap and get cheaper. But now the pendulum has swung, and based on just how short food is, the options are, I can, especially if you look at India and some of these areas, I can grow corn or wheat, or I can grow cotton. What is going to provide the best yield? And even back in 2020, the view was that it was going to be the grains, which was why we did get that supply shortfall. So in cotton, the market still has the potential to rally further. Commonwealth Bank of Australia commodity strategist Tobin Gorey said market discussion has included whether or not cotton prices might head back to $2. In the current supply context, we think that price level is unlikely, he added. Instead, countries with large inventories of cotton lint, such as India and Bangladesh, are likely to sell more and expand their market share. So essentially putting in that floor, that ceiling, again, I would agree with that, where it's unlikely we continue to see this grind back. I mean, $2 would be insane, but we could see some additional increases as they're then incentivized to pull more out of storage and sell to capture some of that market. But when you look at what's happening in terms of new orders, so now we're going to start talking, and this is global, this is not just the US. When you look at new orders versus input prices, new orders are coming down, input prices are staying high. So where is that coming through? It means that people are slowing down, people are buying less, people are just trying to live off of back order because they're still waiting for delivery. So I'm not going to issue new products, especially given where input prices are. So that's where you start to see some of this development of stagflation. And again, not that, and we've been saying this before, it's not that input prices are going to continue to go up. It's that they're just not going to come down. And that's where you're going to see that stagnation on the sideways move, and less about inflation, deflation, but really that pressure that's going to continue to mount as we have shrinkflation, which just means that a package is smaller but the same price, which you're still buying less, but the package looks the same. I retweeted something and talked with Ryan Ray about it with the Barilla pasta, where it's less than a pound, and some of their pasta was already less than a pound, but that has now accelerated. And when you look and just compare, you're losing some of this additional capacity and falling below that pound. But it's not just if you've had Doritos, if you've had any types of chips, if you've had ice cream, essentially bread, eggs, whatever it is, they've either gotten smaller or they've just outright increased prices, or both. And that's where we continue to see that pressure point. And when we talk about credit impulses, we want to look at the U.S. generic government 10-year change and then the G3 credit impulses. So this is one of those pieces where you could say this could pull down some of the 10-year when you look at just general pricing, as we've had that credit impulse percentage come negative, which again would then pull things back down. So there's a lot of shifts in general when we look at where our bonds going to shake out. There's a lot of conflicting data. One of the things that we continue to think is that rates are going to go higher. We think the 10-year will be above 2%. And with my friend who I have a bet with, I think it's 3.5 beers. it'll be above 2% by midterm elections next year. So again, I do think that there will be that pressure point as inflation continues to get priced in, and we head face first into the debt ceiling, because who doesn't love a good debt ceiling back and forth as we've had in previous years. So it's going to come down, do we have a government shutdown? Does the government default on debt? And it's, what are extreme circumstances going to be done to try to prolong our ability to pay interest? Again, a lot of things that are going to come to pass that we will have to, essentially try to manage as we get through it. Now, one of the things that FedEx signals a clear cyclical downturn, which I think is interesting. When you look at FedEx Corporation, they've increased prices by about 5.5%, as we go into next year. And then when you look at world foreign trade, typically there's a decent correlation, if not almost, very good correlation, given some of the extremes are taken out, but you can see that it leads the direction, and we will start to see some of that world trade start to slow down. And if you look back in terms of what we've seen so far with new orders slowing, you still have a lot of backlog, but let's take that backlog in. You're starting to see the consumer slow down a bit. It's still strong, but still slowing, and your prices are going up. So the Baltic Dry Index set its all-time record of over 11,000 points during the 2000-2008 commodity supercycle. Where are we today? Right now, the overall index, which factors in rates for capsize, Panamax, Supramax, and Handysize vessels, jumped 235 points, or 4.7%, to 5,197, its highest since September of 2008. The main index mirrored a jump in Capesize, or 8.4%, to $9,018. Average daily earnings for Capesize, which transports 150,000 tons of cargoes as iron ore and coal, rose $5,773 to $74,786. The increasing number of spot fixtures from the world's largest iron ore exporters are clearly providing a boost to the dry bulk sector. Congestion around China and the approach of the traditionally strongest period of the year for the dry bulk sector will keep spot freight rates much higher. Average daily earnings for Panamaxes, which ferry 60,000 to 70,000 ton coal or grain cargoes, increased to 36,000. So again, they're going higher, and you're getting additional pressure as we go forward. And we're going to talk about that in a minute in terms of how bad that's getting and why it's going to remain a problem as we go through the remainder of the year and well into 2022. But we want to talk about the FOMC economic projections first, because when we look at the Fed, they are starting to take their economic projections, and this is looking at inflation. So let's look at core PCE inflation. In June, things were going to be fine, and in September, they're going to be less fine, and they're starting to see some of this increase. And as the quote goes, he doth protest too much. When I look at Powell constantly coming out and reiterating nonstop, it's transitory, it's transitory, it's transitory. If you have to say it, does it, the more you have to say it, does it make it less true? Like the joke of if you're tough, you're tough. If you have to say you're tough, then clearly you're not. So again, there's a lot of this. We're seeing again, we go through the supply chain. We start at the top and we come to the consumer. There's nothing in that is showing, oh, things are cooling off and getting better. No, there's nothing that says that. You can say in the future, as we go into 2022, you're going to start to see some of that ebbing on the supply chain side, but rents are just getting started. And we'll talk about that in a minute, which again is going to put that pressure and keep that stickiness elevated. I think kind of shaking off the view that this is going to slow down in 22 and 23. And then the number of participants reporting weighted upside risk to core PC inflation is 13. So unchanged from a few months ago, but still a record number of Fed members who see inflation risk to the upside. So again, they're saying transitory, but yet they're saying there's a chance this could go higher. And why? Well, let's look at M2 that has exploded and has shaken off. So if you just take this line and kind of draw another line through it to show where the trend is and where we are right now, it's much higher, which again and we'll talk about RRP, which is now over 1.4 trillion. New record. Good job, guys. Setting us up well for crossing 1.5 trillion as we go into Q4. And then here's just looking at Shanghai Shipping Exchange, China Containerized Freight Index. Again, back to the highs. Baltic Exchange Dry Index, again, back to 5,000, going back the last since 2014. We're just continuing to see freight rates go up, which again is just going to keep prices elevated and keep pressure on just the underlying movements. And this is why when you look at developed versus emerging market delivery times, they're still, especially when you look at developed, they're still slightly better, but still terrible. And they're still the worst that they've been since 2011. Emerging markets, again, getting a bit worse, still not at the peak that it was in 2020, but we also haven't seen the same type of, some of the issues at the emerging market side have gotten a little bit back to normal, but you're still seeing that pressure in general as they make a lot of the raw materials, semi-finished goods, which then delay a lot of the underlying in terms of the developed markets. But there's also the inflation issue. There's also trying to manage price, trying to protect kind of where things are going and manage some of the underlying components, which is like on the emerging market side where we've already seen rates go up. We've already seen them try to adjust. So yes, they're slowing down on the delivery time index and not getting as bad, but they're also seeing a slowdown in manufacturing and in just growth in general, which again is offsetting some of that. So now when we turn to the U.S. and use, I thought this was a good study from the Commercial Construction Index. So contractors reporting high difficulty finding skilled workers rose to 55%, and then contractors facing at least one material shortage in Q3 rose to 93%. So, and as I spoke with Ryan Ray about this, you can make a lot of money as a construction worker, but how much experience do you need? And you're looking at people that maybe were bartenders or or waiters or waitresses, and now they're looking at this and saying, well, my restaurant's not hiring back. Those other restaurants aren't hiring. They're 40% staffed versus, so 60% of the people are not coming back. They don't plan on bringing them back. So construction makes a decent amount of money. And that's where, how much are you willing to train versus take in? So you're seeing this skilled issue becoming a bigger and bigger problem as material shortfalls continue to expand, limiting just the amount of capacity or how fast some of these individuals can run. All the while, the wait for chips grows, and gap between ordering a chip and delivery is still growing. We're still heading higher. There's no sign of abatement. There's no sign of this getting. And again, if you think about 25 weeks, we are now into, or let's just say October 1st. So you're not getting it before the year end, and hopefully you'll get it by the beginning of next year. So again, you're seeing this bleed, you're seeing this move into Q2, into really Q2 of 2022, and then again, we don't see this getting much better even as we end up into 22. It'll start to catch up with itself in the sense of we'll start to crest and then roll over, but it's not going to be this big upside down V. It's just going to be a slow grind. And then I do think we settle out somewhere higher because there is more demand. We still have an issue with supply, and that's going to keep some of this fairly capped. But if you have your CDL license, if you're a truck driver, it pays to be a truck driver. If you want to go to the UK on a 3-month visa, they're offering it for truck drivers. You'll get paid well, and you'll get a visa, and you'll be able to be in the UK. So here's bus driver, CDL, truck driver. There's demand. This is just looking at the U.S., but again, there's demand everywhere. There's shortages of truck drivers. We're seeing that show up. We saw that in the UK when you look at the lines, the queue for the petrol stations. People are panicking. They're trying to buy fuel for their generators, and again, you're seeing a lot of this pressure continue to mount. And then when we look at PMI supplier delivery times in major economies, this is just breaking it out and looking at it a bit differently, where you look at the Eurozone, you look at Japan, you look at the US. Japan and China are much closer to some of the pieces that they need. So you're not going as far as some of the other areas like the US, but when you start, the further out you go, you can see just how this it multiplies. You get exponentially worse the further you have to go, given distance, given container availability, given ship availability, given cost. So that's where you see these lengthening times. And as the Eurozone is starting to get a little bit better. You're starting to get some of the U.S. flattening, but you're not seeing improvement. And that's something that is going to continue as we look at the average delays of cargo ships traveling from East Asia to North America. In September, they're up to 13.7 days. Again, worst so far since COVID. Share of cargo ships waiting to get to port. North America, it's up 41%. And then change in airfare rates, August, September 2021 from 2019. Europe to North America, up over 150%. Globally, over 100%. In Asia to Pacific to Europe, almost 125%. So again, people are paying the price if they want to get it on air freight. Most commercial jets also carry air freight, so less commercial jets means also less air freight. So then again, you're also taking some of that supply out of the market, but you're still seeing a lot of these pressure points. And then the share of cargo ships waiting to get to port by region, North America, again, continuing to worsen over time, which is, again, some of those pressure points. So then when you look at margin debt and stock market moves, increasingly joined at the hip, rolling 24-month correlation between year-over-year percent changes are quite strong and hovering near upper end of historical range, which has gotten much tighter over the past decade because people use margin to get long. If there's a big dip, people use, as they say, BTFD, buy the dip. So this is where we continue to see this tightness, especially as you look as the activity continues to accelerate into these previous months. And then obviously you had government transfers, you had additional capital that you could use. So U.S. quarterly grain stocks, when you look at just where things sit right now, again, kind of shifting into where the movement is, September 1 average is kind of pretty firmly within the range. It's going to be interesting to see kind of where this USDA shakes out. Where does WASD shake out? Because then when you shift a bit further and you look at U.S. weekly inspections, you can see corn at the upper range, soybeans at the upper range, but wheat, a huge swing and a miss. And that's going to be, I think, some of the bigger problems when you start looking at where is wheat priced versus some of the others as that pressure point continues to grow. But then when you look at grains, you look at what is happening in general, well, U.S. average cropland value continues to grow. It's no surprise that guys like Bezos and Gates have been buying up farmland for the last decade. And now I believe it is as of Q1 of this year, Bill Gates is the largest owner of cropland in the United States, and it's going to continue to go higher due to shortages, due to the usage. And again, this is going to be something to watch as food prices continue to go higher. We're at 60-year highs once you factor in inflation. The UN levels, as we've been talking about, they dipped a little bit, but now they're right back to those highs. And it's just going to be that sideways move as countries continue to struggle. We still are at the early end of the harvest. Hopefully we get some surprises on yield, but so far it looks unlikely, which again is just going to put us into a different spot as we go through the remainder of the year. So that's what we have for you on the global side. Now, in the next segment, we're going to look at the U.S., and we want to start talking about, again, that rent side, leading indicators, and what regional Fed banks have been saying about their local regions on prices and manufacturing and just general growth.